This is Nightly Business Report with Bill Griffith and Sue Herrera.
Critical week, an historic summit, a possible interest rate hike, and key economic data. They could all determine whether more fuel gets added to the rally.
Not in the room, President Trump and Kim Jong-un are getting all the attention, but it's China that could decide whether the summit is a success.
Aging in place, why it's important not only to decide when to retire, but also where to spend your golden years. Those stories and more tonight on Nightly Business Report for Monday, June 11th.
And we do bid you good evening, everybody. We are heading into one of the biggest weeks for investors in recent memory, with some calling it the most important week of the year for the world economy. First up, of course, there's the historic summit between President Trump and North Korean leader Kim Jong-un in Singapore. Then three of the most powerful central banks have meetings scheduled. Our own Fed is widely expected to raise interest rates during its gathering this week. Plus, important new inflation data will be released, along with the retail sales figures. And all of this occurs just as Wall Street's major averages inch their way back toward new highs. Today was very much a wait-and-see kind of a day ahead of all of those events. The Dow average gained about 5 points. The Nasdaq was up 14. The S&P gained about 3. Bob Pisani, though, has more now on what investors can expect in the days ahead.
The markets are cautious ahead of one of Wall Street's busiest weeks this year, starting with President Donald Trump's historic summit with North Korean leader Kim Jong-un in Singapore, and ending with three key central bank meetings. The Federal Reserve meets on Wednesday, the European Central Bank on Thursday, and the Bank of Japan on Friday. Bank stocks could be set to rally, as many are expecting the Fed to raise rates this month and the ECB to signal a start to unwinding its own era of easy money. Add to that a pile of economic data, everything from inflation reports to retail sales and industrial production. That's a lot for the markets to digest, but not much can keep them down for now. There's four reasons. First, the right kind of leadership is powering the markets. Tech's still strong, but financials have joined the party now. Together, tech and financials are more than 40% of the S&P 500, and energy's holding on, and retailers have surged as earnings commentary has gotten stronger. Second, trade talk has been confusing, but hasn't sparked any trade tantrum in the markets just yet. Many do not believe that a global trade war is imminent, and traders have become numb to these endless tweets. Third, the Fed is perceived to be on top of things, but not overreactive, not raising rates too fast. Job performance is good, wage growth is good, but it's not overheating. It's steady as she goes with gradual tightening. Fourth, the U.S. growth outlook is solid. Real estate investment trusts, for example, have rallied 5% off of their May lows. Now, REITs are perceived to be interest rate sensitive. They are, but they're also cyclicals, and they're helped by better economic growth as well. For the moment, there's a lot more upside than there is downside. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
So, with many political and economic events on the calendar, how should investors separate the noise from what really matters? Joining us to talk about that is Kenny Polcari, director of the New York Stock Exchange Floor Division at O'Neill Securities. Great to see you again, Kenny. Welcome back.
Thank you, Sue. Great to see you as well.
I think that is the question. There is so much headline noise out there this week.
Right.
If you're a longer-term investor, what should you do?
So you have to eliminate the noise, right? Certainly for the long-term retail investor, the worst thing they can do is concentrate on everything that we're describing as noise. And look, the G7, as significant as it is noise. The U.S. and North Korean summit, okay, that's all well and good. It's historic, but really nothing's going to be accomplished in a 2-hour meeting that Trump and Kim Jong-un are going to have in 2 hours, right, at 9 o'clock p.m. our time. And so therefore, as long as the news isn't negative, as long as the headlines aren't negative about that meeting, then the market will be okay, right? What people should be focusing on is get rid of all that. And what you should be focusing on is, as Bob said, and as you said, the Federal Reserve, what they say on Wednesday, what the ECB says on Thursday, and what the Bank of Japan says on Friday, along with the broader macro data, which is really going to be all those events is what's going to be what prices stocks, right? The noise, G7 and the summit are not going to price stocks in the long term, and they'll just cause investors to get anxious.
So the expectation, Kenny, is that the Fed raises rates on Wednesday for the second time this year.
Right.
We wait to see what they might suggest about the future. What do you expect rates to do? How do you position yourself with interest rate vehicles right now?
So look, we've been talking about this for a long time. So you're not going to necessarily position yourself for the news coming out on Wednesday. You would have already started to do that, right? It's been well discussed that rates are absolutely expected to go up this week on Wednesday, 25 basis points, certainly well within. I think, and if you've been buying into the story about what rates are going to do in September, then you're positioned properly. Financials will do well, certainly in a rising rate environment. And if they come out and they talk about the strength of the economy, then you have to start certainly looking at the other sectors. Tech is always going to be strong. I think tech is absolutely going to remain strong. But like Bob said, retailers are all of a sudden starting to lift their head. Energy has performed very well and will continue to perform well in an economy that is strong. Right. So I wouldn't be making any major changes ahead of this news coming out on Wednesday. Now, if they come out and they say that there's a fourth rate hike in the works, then that might cause a little bit of anxiety for the market. But it depends on how they position that.
One of the other big events this week is a possible decision on the Time Warner deal, the Time Warner AT&T deal.
Right.
What are the implications of that for investors? And depending on what happens, what does it do to the merger and acquisition landscape?
Okay, so the one thing is it's going to be that sector specific, right? So it's going to be television, media. That's going to be the sector that's going to react one way or the other. Certainly, retailers don't care about what happens, nor does anything else. But here's the deal. I think the Time Warner deal is priced at $103 a share. Time Warner closed, I think, today around $97, which leaves a little bit of room that investors are just a little bit cautious that it could go either way. If the deal gets prevented, if they block the deal, certainly look for Time Warner to back off, probably goes back to somewhere low to the mid-80s. Watch also for Telephone to back off just because of the opportunity lost, right? Then I think it's going to talk about that whole sector. The Comcast-Fox deal that's in the wings waiting for this decision is either going to be on or be off, right? If they block this merger, then the Comcast deal is going to be off. If they let this merger happen, then you can expect that Comcast is going to make a bid for Fox, as they have indicated that they're going to do.
Thank you, Kenny.
Thanks, Kenny.
As always, Kenny Polcari with O'Neill Securities. Bill?
Investors across the globe will be watching and waiting to see what happens in Singapore when the leaders of the U.S. and North Korea meet there. But there's another country that could influence the talks as well, one that will not be in the room with the two leaders. That country is China. Eunice Yoon has our report for us tonight from Beijing.
Beijing won't be physically in the room, but its presence is already being felt at the summit. The most obvious symbol is the image of North Korea's Kim Jong-un arriving in Singapore on an Air China plane on loan from Beijing. President Xi Jinping has every reason to want this summit to be a success. Officially, the Chinese have been encouraging dialogue and denuclearization. The foreign ministry said today China hoped to see a positive result. China and the U.S. have a lot of issues on their plate, like trade and North Korea. Removing North Korea as a regional security concern would be in President Xi's interest. At the same time, there's likely to be some discomfort that China doesn't have direct control over the proceedings. For years, the U.S. was trying to resolve issues with North Korea through a different framework, the six-party talks, with China playing a broker role. So this is unfamiliar territory for China. If China doesn't like the outcome of the summit, it does have an ace up its sleeve. Beijing has economic leverage over Pyongyang. So if Beijing doesn't like the deal, it has the ability to undermine it by easing up on pressure on North Korea. For Nightly Business Report, I'm Eunice Yoon in Beijing.
And while much of the world is indeed focused on President Trump's summit in Singapore, there is growing concern about his threats to slap a tariff on vehicles imported from Canada. Some of the most popular cars, trucks, and SUVs here in the U.S. are built north of the border. Phil LeBeau has more on what's at stake if tariffs are slapped on those vehicles.
The next time you look for a new car, truck, or SUV, look closely at the sticker on the window, and you'll likely find it was built in Canada. Chrysler minivans, Chevy SUVs, and the Ford Flex all roll off assembly lines in Canada. In fact, more than 11% of the vehicles sold in the U.S. last year came from our neighbor to the north, which is one reason the U.S. runs an auto trade deficit of almost $27 billion with Canada. That rankles President Trump. And when the G7 meeting turned contentious, Trump threatened to hit Canada's auto market. tweeting, "I have instructed our U.S. reps not to endorse the communique as we look at tariffs on automobiles flooding the U.S. market." Canada's Prime Minister is not backing down.
I stand ready to work closely with the President to resolve this dispute swiftly, but as I have consistently said, I will always protect Canadian workers and Canadian interests.
If the U.S. breaks the NAFTA agreement and puts a tariff on vehicles built in Canada, it's hard to predict what it will mean for car and truck prices here in the U.S. Some estimate prices could rise between $400 and $2,000 per vehicle. But so far, auto executives are treating the trade tensions with Canada much as they have the trade tensions with Mexico. In short, automakers are taking a wait-and-see approach. Until the Trump administration actually imposes tariffs on vehicles from Canada, the auto industry will plan on continuing to import millions of vehicles from north of the border. Phil LeBeau, Nightly Business Report, Chicago.
So while automakers are taking that wait-and-see approach, some steel companies are restarting their factories thanks to changes in trade policies and an increase in demand. But the decision to start up production again isn't without risk. Jackie DeAngelis is in Granite City, Illinois for us tonight.
U.S. Steel's Blast Furnace B in Granite City, Illinois. Employees say you could hear a pin drop here. It's been idle since 2015. Now it's up and running, and the energy is palpable.
In March of this year, the company made the decision to restart this facility, in part due to strong demand, but also because of President Trump's decision to impose tariffs on imported steel and aluminum.
We're actually now seeing our government stand up for the steel workers, and this is a really good thing for us. We'll have to see how this all plays out, but we think this is a good first step, and maybe Canada and Mexico and others will come to the table. We've seen the South Koreans come to the table, and we actually end up not having tariffs, but also putting in place some quotas. So this is a good first step.
It took about 12 weeks to get this furnace functional, but it now is part of the steel production process for manufacturing of things like washing machines, refrigerators, auto products, and tubular pipes. A lot of the excitement here is coming from employees. 500 people will work here, many of them rehires who had lost their jobs, some of them new hires. When Blast Furnace A comes online in early October, another 300 more jobs will be added.
It's comforting, I guess, to be back to work. It's a big change. It means everything to people here. You know, their security for their family, health care, retirement plans for some people. So it's a big deal here. A lot of people excited to be back to work, a lot of new jobs being created. One of the things I think that is overlooked sometimes, obviously, big impact for the steel workers. But there's also, like me, I'm a bricklayer.
U.S. Steel says the restart of this facility is important because it's representative of action to help revive the industry. But action to revive one industry could hurt another. A study by the Trade Partnership finds that the tariffs, quotas, and retaliation would increase the annual level of U.S. steel and aluminum employment by more than 26,000 jobs over the first 3 years, but would cost other industries more than 400,000 jobs. That's 16 jobs lost for every steel and aluminum job gained. For Nightly Business Report, I'm Jackie DeAngelis, Granite City, Illinois.
The Treasury Department imposed sanctions on 3 Russian individuals and 5 companies today. The U.S. says they worked with Moscow on ways to conduct cyber attacks against the U.S. and its allies. The designation prohibits American citizens from engaging in transactions with them. The White House had blamed Russia for a global cyber attack in February that it says caused billions of dollars in damage.
Time to take a look at some of today's upgrades and downgrades, and we begin tonight with ConocoPhillips, which was initiated with an outperform rating in new coverage at BMO Capital Markets. The analyst there cites robust free cash flow, the potential for increased stock buybacks, and dividend growth. Price target now $78. That stock rose 1.5% to $70.49. Jefferies is looking at energy companies in the Permian Basin and today upgraded Cimarex Energy to buy from hold. The analyst cited an improved production outlook and the potential for a dividend hike there as well. Price target $107. The stock rose nearly 2% to $87.25.
That same analyst at Jefferies downgraded shares of Oasis Petroleum to hold from buy. The firm cites the stock's valuation after a 50% rise over the past 3 months. The price target is $14. The stock closed just below that level at $12.87. First Data was upgraded to buy from neutral at Goldman Sachs. The analyst cites the potential for improved revenue growth. The price target is $25. The stock was up 2% to $20.48.
Still ahead, the multi-billion-dollar video game industry is powering up as some of the big players battle upstarts. Today marked the official end of the regulations that govern the internet. Those rules that were widely known as net neutrality mandated that internet providers could not block or slow down certain websites or prioritize some content over others. The repeal was led by the current chair of the FCC, who today said that customers are not going to see any change at all.
From this day forward, I think our interest is making sure that we have a free and open internet and that consumers are able to get better, faster, cheaper internet services. That's what I hear when I travel around the country and talk to consumers everywhere from Los Angeles to the Rosebud Sioux Reservation in South Dakota to just a couple of weeks ago in Dahlonega, Georgia. This is the regulatory framework that's going to lead to the better internet that consumers want.
The vote to roll back the rules occurred in December, but it took time for them to be implemented, which is why they are now expiring today.
At Comcast shareholder meeting, CEO Brian Roberts was asked about the internet rules, and he said that his company does not block or throttle traffic and that he supports an open internet. He also commented on Comcast's interest in some of the assets of 21st Century Fox and, more broadly, the potential for growth through acquisitions.
As we discussed during our recent conference calls and webcasts, opportunities arise for us to create more value for our shareholders, like we did with NBC Universal. Our current offer for Sky, as well as our announcement last month that we're also considering and are in advanced stages of preparing an offer for the businesses that Fox is selling, are perfect examples of this. Importantly, we set the bar high. We haven't been and will remain disciplined.
The bid for Fox's assets could hinge on the outcome of tomorrow's expected ruling in that AT&T Time Warner antitrust case. According to reports, if the AT&T Time Warner merger is approved, Comcast's official bid could come Wednesday. As you're probably aware, Comcast is the parent company of CNBC, which produces this program.
The video game industry is riding high these days. I mean, just ask anyone who plays that hot new game Fortnite. Industry profits are up, so are stock prices. But the $100 billion industry is also undergoing a lot of changes, and that was evident at the annual E3 Expo that attracts some of the biggest players in the business. Julia Borston has more for us tonight.
This year, E3 is all about the new games designed to attract new fans and to stick out from the crowd. Microsoft's Xbox presentation unveiling new and exclusive content and easy access to it. Microsoft showcased 52 games, including 18 exclusives for the Xbox console, also announcing it's buying 5 game studios. Xbox is also adding more games and features to its $10 a month Game Pass subscription. Microsoft's head of gaming, Phil Spencer, saying the service's changes will accelerate its growth.
What we're seeing today in Game Pass is not only an expansion in subscribers, but the people that subscribe actually play more games. So for the industry itself, it drives higher engagement across more franchises.
One game everyone's talking about here at E3 is Epic's Fortnite. It's gone viral in part thanks to the ability to play with big groups of people and also across both consoles and mobile devices. Fortnite's success prompting console makers like Xbox to make changes to support that kind of gameplay and prompting its rival game makers to make changes to take it on.
We're continually working with Epic about how to make that game even bigger. They're doing a lot of esport work this year. Xbox has always been a great place for multiplayer games, and Fortnite's a huge hit for us.
In response to Fortnite's success, game maker giant Electronic Arts announcing it's launching a Battle Royale mode for Battlefield 5, enabling massive groups of people to play, just like with Fortnite's popular 100-person mode.
The Battle Royale mode is becoming very popular, not just with Fortnite, but we've seen it in other games as well. And so for major publishers like EA, like Activision, to respond quickly to adapt their games to this trend, I think is a smart move, and there's not much at risk for them.
Electronic Arts also announcing a subscription service, EA Origin Access Premier, for its PC games, as more game makers start to embrace this model as a way to bring in new revenue and keep gamers hooked. For a Nightly Business Report, I'm Julia Borston in Los Angeles.
Boston Scientific is reportedly a takeover target, and that's where we begin tonight's market focus. The Wall Street Journal says the medical device maker Stryker made a bid for its rival. A potential deal would create a company worth more than $110 billion. Boston Scientific said it wouldn't comment on the report. Shares of Boston Scientific rose 7% to $34.32. Meanwhile, shares of Stryker were off 5% to $169.78. United Airlines said passenger traffic was nearly 7% higher in May versus a year ago. Investors seem to like that news, sending the shares up 3% to $72.15.
California state officials have revealed that some of the wildfires in that state last year that killed 46 people were caused by power lines operated by the utility Pacific Gas and Electric. Officials also said that there is evidence that PG&E violated state laws, which is a sign that the utility may face some legal issues at some point. Shares of PG&E fell 4% to $39.76. Dave & Buster's reported a smaller than expected decline in same-store sales after the bell tonight. The restaurant and gaming chain also gave guidance for the year that was in line with estimates and announced that its CEO is retiring, but he will remain as chairman. Shares were initially higher in the extended session. They finished the regular day up a fraction at $47.83. Also after the bell tonight, RH, formerly known as Restoration Hardware, reported earnings that topped estimates. For the full year, RH also sees earnings ahead of expectations. Shares were initially higher, and after hours, they finished the regular session up nearly 5% to $118.73.
Coming up, do you want to age in place? Well, then you also need to consider aging in the right place. The governor of New Jersey signed a bill into law today that legalizes sports betting at casinos and racetracks. It's estimated that the law will generate about $13 million for the state in the first year of operation. Last month, New Jersey prevailed in a Supreme Court case which struck down a federal law which had limited sports wagers. New Jersey's law follows a similar one in Delaware.
The head of Walt Disney Animation and co-founder of Pixar is leaving that company. John Lasseter is going to exit at the end of the year. He was the creative force by movies like Toy Story, Frozen, Finding Nemo. They brought in billions of dollars at the box office. The decision was made last Friday, and it comes after a 6-month leave of absence for Lasseter for what he described as personal missteps.
Being able to afford to stop working is important in deciding when to retire, but you also want to consider where to live to make sure you're aging in the right place. Our senior personal finance correspondent Sharon Epperson joins us now with a new report on the best and worst cities to retire to. It's great to see you, Sharon.
Good to be here.
It's great to have you here. If you're trying to decide where to age in place, what are some of the factors that basically we all should take into consideration?
Well, we all should take into consideration because the majority of Americans want to stay put. They want to stay in their home. They want to stay in their own community. And some of the things to consider, a new survey out by Magnify Money looked at these factors such as lifestyle, how much you're volunteering, how much you're engaging in the community as part of the lifestyle component, cost of living, of course, you're renting or owning on a fixed income, so that's so very important, and also medical quality and cost. Medicare does not pay for everything when you're a senior, and many seniors don't realize that and need to know how much is coming out of pocket, so that was a consideration. And also access to assisted living, and that includes home health care providers as well as community centers that allow you to kind of age in place there and get assisted living as you need it.
So bearing all that in mind, what did the survey say about the worst places to retire then?
Well, believe it or not, sun and sand in Florida is not necessarily the place that you want to go to retire. Miami did not do very well on this list, and a lot of that had to do with the fact that Miami is one of the places where people are not able to get quality medical care, perhaps at the lowest price as some of the other 50 largest cities in this survey. The worst, though, was actually New York City. And cost of living, of course, a major factor there, but also access to volunteering and those lifestyle engagement statistics that many say are important, so that people are looking out for you as much as you are volunteering and looking out for other people.
All right. What about the best places? Where are we going, Bill?
Where am I writing this down?
The Midwest, Denver and Salt Lake City did very well. Cost of living there is great. But actually, Portland, Oregon was the top contender. And a lot of that has to do with the share of people, more than any other city, saying that they wanted to move there. 65 and older, if I'm going to move to Portland. They're choosing to go there. The cost of living is very good. Health care service is very good. And those are major reasons why people want to go there.
Well, now we know. All right, Sharon Epperson, as always, thank you.
My pleasure.
To read more about retiring in place, head to our website, nbr.com.
And finally tonight, Justify, of course, made history over the weekend. Hope you saw that. After winning the Triple Crown, the 3-year-old colt's value skyrocketed to $60 million, with the potential to go even higher. Forbes estimated that Justify could demand an initial stud fee of $100,000, depending on the racing performance of his offspring. The value could climb. Justify was originally purchased, you ready, for $500,000.
Before we go, here's a look at how stocks fared ahead of the U.S.-North Korea summit. The Dow added just 5 points. The Nasdaq was up 14. S&P 500 gained about 3. So that will do it for us tonight on NBR. Thanks for joining us.
I'm Bill Griffith. Have a great evening. Age in place.
Yes.
It's a wonderful concept. We'll see you tomorrow.